All right, guys, Cody Sperber here, the Clever Investor, CEO of cleverinvestor.com, and I want to welcome you to my Periscopes. If you guys haven't been on any of my Periscopes before, you're in for a real treat because I'm one of the few educators out there that come to you live with my trusty little whiteboard, and I give you information that you cannot find anywhere else for free. This is my gift to you to help you get going on your journey as a real estate investor. I remember that I had a lot of smart people helping me when I first got started, motivating me, training me, showing me a lot of really creative and cool things. It opened up my mind to this whole world of creative real estate investing, and ever since then my business has taken off, and I've made an absolute fortune. I've done over 1,500 real estate transactions, and I've had the honor and privilege to teach good people like you how to do the same and turn into absolute real estate superstars. So, with that being said, we are working through a series of training videos that we're titling How to Make $1 Million in 2016. And we've gone through all of these different stages up to the point where we're at now. We're on stage 5, strategy and funding. All right, so we talked about stage 1, which was setting up your business the right way. We talked about stage 2, which is all about lead generation. Stage 3 was processing those leads. Stage 4 was acquisition, and now here we are on stage 5. So if you missed those training videos, or you're watching this as a replay, because I do put these videos up on YouTube, you can go back and watch those previous training videos because they're all up on YouTube for you to enjoy. All right, this is hardcore training. All right, this is, people pay thousands and thousands of dollars for this information, and I'm giving it to you guys right here. And if you're wondering what those hearts are, we're on Periscope. So if you're watching it in a replay, those hearts are, people liking what I'm talking about. All right, so today we're going to dive into strategy and funding. So one of the things I had a hard time understanding as a new real estate investor was how was I going to pay for my properties? Because honestly, I didn't have any money. I was actually negative money. I had like $30,000 or $40,000 in credit card debt, and that was all the money I had to my name. So I had to figure out some really creative ways to buy these properties. First, I thought I actually had to buy them, and then I realized, wow, I don't actually have to buy them. I can control real estate deals and flip them and flip the paperwork and do a couple different creative methods. Maybe it's a seller financing, maybe it's a subject to transaction, maybe it's a wraparound mortgage, maybe it's just a traditional wholesale deal where I'm double closing or assigning a contract. There's this whole world of creative real estate investing, and once you kind of dive into it, it's like being a contractor with a bunch of really great tools in your tool belt. And the more tools you have, the more money you can make as a residential real estate investor, all right, which is what we're going to be focusing on. So when I talk about strategy, our goal is for you to become what we call a transactional engineer. So I'm going to put that as our main goal. Once again, go ahead and try and not trip on whatever that was. All right, our goal equals to be what's called a transactional engineer. You guys ever heard that phrase before other than when I say it? Transactional engineer? What's cool about transactional engineering is every single deal is unique, right? So when I show up to a motivated seller's house, or a real estate agent brings me a deal, I kind of have like my goals in, I'm kind of saying to myself, I want to do more rehabs, or I want to do more wholesale deals, or I want to make the most amount of money possible from every lead. But until I dissect the deal, I'm not really sure which box I'm going to put this particular lead into. And so it kind of works like this, all right? It kind of works like this, and I'm going to actually, let me erase this so I have a little bit more room. Okay? Okay? There's really 4 different types of deals that we can do out there. There's really 4 different types of deals that we can do out there. I want to make sure nobody else is causing issues. Please, guys, on these scopes, just keep it super clean, all right? A lot of families watching, All right, so there's 4 different types of deals that are most deals fall into. Some are no money, and some need money. Okay, so some are no money and some need money. Some produce what we call quick cash, and some produce cash flow until you sell the asset. All right? So what's something that needs no money? What would be a type of real estate transaction that doesn't need any money? Very little money, maybe just an earnest deposit. Hint, hint. A wholesale deal. Okay, we call these quick flips. Okay, quick flips don't need money. Wholesale deals don't need money. And whenever you're wholesaling, we'll talk about this, the most risk you have in the deal is whatever amount of earnest deposit you put down if you structure the deal correctly. So quick flips don't need money, but they produce quick cash if you close out a transaction. So anybody who's looking to get into real estate without a lot of money and wants to get bags full of cash, and you want to focus on quick flips, aka wholesaling. What's another thing that might not need money? Okay, very little money. Is there another real estate strategy or a group of real estate strategies that might require very little money out of your pocket? There you go, you're starting to see them. Lease options, seller financing. These are what we would call creative deals. Creative. Creative deals, those are your subject to transactions. Those are your wraparound mortgages. Those are your seller carrybacks. Okay? And we're going to talk about those today. Those are the creative deals. Typically with creative deals, it's a creative way for you to add a property into your rental portfolio without having to just go down to the bank, borrow money, and buy it, or having to come to the table with a bunch of cash. You can step into other people's financing. You can get the seller to finance you. There's all kinds of creative ways to acquire a new rental property. Now, needing money, okay, what would produce quick cash where you need money? You guys finish the sentence. Fix and flip. Boom. So fix and flip is what you see on TV, right? You see these guys flipping and flopping and trying hard to do their real estate rehabs on TV. And you know, what's cool about a fix and flip, if you structure it right, you shouldn't be like the people on TV that are like hanging drawers and cabinetry and doing the actual work. You should do these, what I call no hammer needed fix and flips. Cody Sperber's best use of his time is not to go and hang cabinetry or install a toilet or something like that. My best use of time is to go find another deal and put my money to work and figure out how I'm going to duplicate my dollars. So if you do this right, you can use, even though you need money to acquire the deals, could you use OPM? You can use OPM, right? Other people's money. So even though it requires money, there's some creative ways to finance these deals, which we're going to talk about, where you don't need to use your cash. You can use your experience to find the deals and structure the deal and pull all the players together, but you don't actually need to finance it yourself. And I've done a lot of rehabs using what we call private capital or hard money or other people's money. Okay? And then down here, what would this last square be? What would the last square be? So it needs money and it produces cash flow. Being a landlord, that's right, having rentals. Okay? So we can call these a number of things. I like to get a little creative just because I'm the clever investor. So I call that buy, fix, and stay, or buy, fix, and hold. Sometimes I don't even fix it. I just buy and hold. Okay? All right? And those are your cash flow deals. So now that you guys kind of can see, I call this my 4-square strategy matrix. So until I'm analyzing the deal, dissecting it, ripping it to pieces, looking at it from all different angles, I'm not really quite sure what category I'm going to put my deals in. All right? Maybe I'll start off saying to myself, man, I'm gonna fix and flip this, but then I realized, you know, it's kind of a skinny deal. I had to offer the seller a little bit more than I wanted to. I'm going to throw it over into the quick flip category, and I'm going to launch it out to my buyers list and just make a quick buck. Let somebody else take that risk. Maybe I'm not quite sure what the back-end comps are. I'm having a really hard time nailing value. So I change a lot. Sometimes I show up thinking I'm going to make an all-cash offer, but then I end up doing a creative deal and putting the property into my portfolio. Is this making sense to you guys? All right, I want to see those hearts coming, guys. I want to make sure that I really see. All right, so now that's the setup to today's training. Now we're going to dive in. How do we finance all these deals? Where's the money come from? Okay, where's the money come from? So let's just go through a roll call of every type of financing strategy out there. Let's talk about the creative deals. Let's talk about subject twos. What does it mean? How does it work? What is the paperwork? You guys want to get into this stuff? Because this is the transactional engineering stuff that the pros use to maximize profit. Somebody just says, do you do real estate training? Nope. I'm an insurance salesman. All right, so I'm going to erase this. Okay, you guys want to take pictures, do whatever you guys want to do. So you guys can see it one last time. Cool. All right, so I'm going to erase the 4-square. Get that back. What am I drinking? I'm drinking tea of a kind, citrus mint green tea. Thanks for asking. All right, so here we go. We're gonna start diving in. We're gonna go through all the different types of funding, and as we talk about funding, you'll start to see why we're talking about certain types of funding, so you can start pulling in and saying, you know what, I'm gonna shift my strategy from wholesaling over to creative because I now understand what it means to do a creative real estate deal. All right, so let's talk about hard money. Have any of you guys actually used hard money for any of your rehab deals? Hard money, hard money. What does it mean to be? Does it mean the money is actually physically hard? Hard money is a term. Using it next month, all right, cool. Most people say no. Hard money does not mean that the money comes to you like in a bag of coins or a gold block or anything like that. Hard money is a type of financing, and they're these hard money lenders, they're asset-based lenders, all right? Asset-based lenders, and they can quickly fund investment properties, typically fix and flips, and what the terms are normally 12 to 20% simple interest rates, and they normally go for a period between 3 and 12 months. So let's say I have a potential fix and flip. I might be able to show up and get a quick loan on it between 12 to 20% interest. Right here in Arizona right now, it's right about 14%. Sometimes there's some fees to get into the deal, but they don't even care about Cody Sperber, okay? They look at the deal, and the deal defines whether or not they lend on it. So they'll look at the deal and they'll say, what'd you buy the deal for? What is it actually worth? What needs to be done to it? So they base the loan off the asset itself. So maybe I'm brand new and I don't know my head from my you-know-what, and they'll still land on that deal because they're understanding I'm coming in with some skin in the game. Typically they want me to put money down. Normally it's between 15 to 25%, okay? So I'm gonna put some money, some skin into the game, which sometimes I even got some private capital to fund that initial portion, but the hard money lender funds the rest, right? And you can typically do it within a few days. So I could show up on a Monday and get funded by Wednesday. So the benefit of hard money is it's quick, all right? And we'll talk about some of that stuff. But there's normally a couple different types of hard money loans. So let's say you want to buy a house for $100,000. It needs $15,000 in rehab. Let me think. I'm just trying to come up with some scenarios. You want to be able to put 15 grand into it and sell it for 210,000. All right, and it's going to take you 6 months to do it. You would come in and get a hard money loan to be able to pull that deal off. And there might be different options. You know, maybe one hard money lender says, I want 15% down. I'll do 18% interest for 6-month term. Maybe that's what hard money lender number 1 says. And then you ask them, okay, do you have any fees or doc fees or points up front? Yeah, I have some fees. You know, I have a $1,000 doc fee. So you can start to work your numbers backwards and say to yourself, is hard money lender number 1 a good deal for me? Okay, maybe not, because maybe hard money lender number 2 wants 20% down, but they have an 8% interest rate with 2 points up front or something like that. Maybe hard money lender number 2 is better. Maybe hard money lender 3 wants 20% down and 14% interest. I mean, they're going to be all over the place. It's your job to go and shop these lenders. Try to find one, okay, that understands that the goal is to get in. Well, I don't even want to say understands. Try to find one that doesn't have heavy points up front or heavy doc fees. Most times, there's at least one hard money lender in your area that does not charge heavy points up front and heavy doc fees, and find a competitive hard money lender, somebody that is trying to earn your business. If they're really stern on their pricing, sometimes they're not the best hard money lender for you. And for me, I like it because it's quick. I like it because I don't need any experience. And a lot of times I leverage the hard money lenders' relationships to get into other deals. So maybe I'll go to a hard money lender and say, do you know anybody that is paying cash for properties, and then try and get them to connect me with a cash buyer. Maybe they know access to really great investor-friendly real estate agents. There's a lot of other relationships you can get from local hard money lenders. The downsides are you can get stuck in a bad loan on a bad deal, a high interest rate loan on a bad deal. That's really challenging if your assumptions at the beginning of the rehab are off, meaning you thought it was only going to take you 3 months to rehab, it ends up taking you 6. Or you thought the property was going to be worth $250,000, but it ends up being only worth $220,000. So there are heavy risks with hard money, but what's great is the word leverage. Leverage, you should always leverage. Leverage everything, okay? I'm a huge fan of leverage. Leverage people's experiences, their relationships, their financing, their money, everything, all right? And I went out and I raised $2 million one time. This was back maybe like 6 or 7 years ago. I raised $2 million. Then I took that $2 million and I multiplied it by like 10x because I used the $2 million to go and put the down payments on hard money loans, and then I bought hundreds and hundreds of houses. And I was turning and burning through those houses really quickly. So it penciled, it made a lot of sense, and at the end of the day, even though there was a lot of risk, there was a lot of reward left over in there for me. Excuse me. We'll get into how I raised that here in a second. All right, so we understand what hard money is, and we know that hard money is high interest rate, asset-based lending. Have you ever heard of soft money? You know what soft money is? Soft money is a version of hard money, but instead of it just being simply asset-based, they start to look at you, okay? And so they take a look at your personal credit. Maybe they want you to back the loan personally, sign a guarantee. And it typically comes with a lot lower interest rates. So where hard money might have 14%, 18%, 20% interest rates, soft money might have 7, 8, or 9% interest rates. So you're getting into a much better position, especially if the project takes a long time, but it's a much slower lending process. Where hard money, you can show up on Monday and get the loan funded by Wednesday. Soft money typically takes a couple weeks, like 2 to 3 weeks, I would say, on average for soft money. And they're credit-based lenders and asset-based lenders. They typically lend for a longer period of time, like 6 to 24 months. Hard money lenders rarely want to go past 12 months. Most of them are 6 to 12 months, whereas soft money goes from 12 to 24, a little bit longer. No matter what lenders you get, soft or hard, they do not want you living in the property. These are for investments only. And if you tell them you're going to live in the property, they're not going to lend you, okay? Soft money funds a lot slower. And I love soft money because it's a cheaper form of financing. And you can find soft money lenders just simply by getting investor referrals or just Googling soft money lenders in your area. Hard money lenders, you can find them, and my favorite place to find them is through investor referrals. Go to your local RIA, start talking to other local wholesalers, ask them what hard money lenders that they utilize. Most wholesalers have 1 or 2 or 3 hard money lenders that they have good relationships with, because when you're wholesaling, you're moving properties really fast. You always want to be able to tell your buyers, hey man, call Joe over at ABC Capital and he'll get you financing. Or hey, this deal already has approved financing on it, call my buddy Joe. Is this making sense? Cool. Okay, so we talked about hard money, we talked about soft money. What about transactional funding? Have you heard of a transactional lender? Transactional lending? Some guy just made fun of my shirt. Do you guys like my shirt? Because I can take it off and do the rest of this training just no shirt. All right, I'll keep the shirt. I'll keep the shirt. All right, thank you. Tell that guy to beat it if he doesn't like my clothes. All right. So let's talk about transactional lending. It's also known as one-day dough, and what's great about transactional lending is it's short-term financing. Okay, very, very short-term financing for very specific niche type of flips. So let's say you're going to flip an REO, a short sale, a HUD property, or any other type of deal where you're being forced to actually take the deal down. What I love about transactional financing is, let's say I have a wholesale deal where I want to flip an REO or a short sale or a HUD property. Typically what I do is I lock the property under contract, okay? Open up escrow. Then I go and find a cash buyer that's willing to pay more, and I get them into escrow. But sometimes I can't use this cash buyer's money to finance the acquisition. So what I'll do is I'll insert transactional lending in the middle. And a transactional lender will fund this 100% of my transaction. Meaning I don't have to put any money down because they know that I already have the back-end buyer lined up. Now they'll do this, it's called one-day dough or 3-day dough or whatever. They'll do it because they know their money's going to be at risk for a very short amount of time. The back-end buyer is already locked into the deal and their money is already in escrow. The transactional lender lends on the deal, buys this property, and immediately we resell it to the back-end buyer and use their funds to close it out. So it's like a bridge loan, if you want to think of it that way. It's bridging the gap between two transactions that need to happen very, very quickly back to back, but you cannot use this buyer's money to fund the original acquisition. This happens in REOs and short sales and some other HUD. If you buy a house off a HUD home store or maybe auction.com or some of these auction sites, you can use transactional lending. It's great because they'll fund 100% of the transaction. meaning you don't have to come into the deal with any money whatsoever, but they might take, say, 2 points. Well, if you have this under contract for 100 and this you're selling for 115, and you know you're about to make a $15,000 spread, would you give up 2 or 3 grand to not have any risk, not put out any money, do nothing, and just quickly make a quick 12, give 3 to the transactional lender, let them take their little cut, you take 12 and you're off to the races for the next one? Absolutely, I would do that all day long. There are transactional lenders out there, typically hard money lenders and soft money lenders will do transactional lending. All right, so you don't have to, it's not hard to find transactional lenders. You can get a referral, you can Google them, they're out there, all right? Okay, you guys understand that. So let's talk about conventional financing. Conventional financing is a very traditional model, right? So we've been talking about some creative things, and a lot of times those are used for either fix and flips or creative wholesale deals. Conventional financing is where you're personally liable. It's a much longer term loan. It's a very low interest rate. What are interest rates right now on traditional home loans? 4%, 5%, something like that? I mean, they're pretty low. Do we expect them to rise? Maybe a little bit, but you know, they're pretty low. The challenge is, okay, and there are 3 buckets of conventional loans. There's government-backed loans like an FHA, a VA, a USDA loan. There's conventional loans that are backed by Fannie and Freddie, and then there's portfolio loans, which are creative loans. So we have these 3 buckets of loans. Majority of those, meaning government-backed loans, like an FHA loan or a VA loan, those are typically for homeowners that want to live in a property, right? They're not really into lending to investors. Portfolio loans are normally used, those are in-house loans, and those are normally done on like weird non-warrantable condos and weird things. Conventional loans are pretty much the only type of loan out there that I know of that will lend to investors, but they want you to put 20% down. They're going to rip you to pieces trying to figure out who you are and what you're all about. And it's going to be a very tough process to actually get a conventional loan, especially if you're an entrepreneur. It is a pain in the you-know-what. So, you know, conventional lending, you know, it's there. Would we really want to use it? I don't think so. So a lot of times we use hard money or private money or soft money or transactional lending, or we show up and we ask the homeowner some very dialed in questions to figure out whether or not they can participate in the financing. And this is where it starts to get sexy. You guys listening? Guys listening? Okay. I just did that. Cash versus. You guys have heard me say this before. Cash versus terms. Cash versus terms. Okay? Every time I show up to a seller's house or I'm looking at any deal, I'm always thinking cash versus terms. All right? And I'm trying to understand if there's a creative deal structuring in there that I can do where the seller is going to be able to or willing to participate. All right? Now, when I talk about the terms, you know, I can always go in and say, hey, I'll pay $100,000 cash. Well, maybe that's too low and they don't want $100,000 cash. They want $150,000. Then I switch gears and I go to terms. So I'm always coming in with two offer type of approach. When the cash doesn't work, or I feel like terms is better for both me and the seller, I'll shift gears to terms. And here's what I mean by terms. Okay? When I'm talking terms, I'm talking subject to. Okay? I'm talking a wrap. I'm talking about seller financing. All right, this is the world of creative real estate investing. All right, if wholesaling is creative, this is super creative. So, have any of you guys ever done a subject to transaction? Yes, maybe? Some people are saying yes, many. Some people are saying no. Subject 2 is really cool because a lot of times we can show up in a situation where the seller wants to sell. They're not willing to take a big discount on the sales price, maybe because they can't, because they owe, let's say, as much as the house is worth. It's in a price bracket that's low enough that if I was to get control of this house some creative way and I rented it out, the rental rates in the area are really strong. So maybe the seller owes $80,000 to the bank. The house is only worth $80,000, but it rents for $1,250 a month. But on that mortgage that they're paying, they're only paying $750. So there's like a spread. It's called arbitrage, and we're arbitraging the spread between the $750 that's owed to the bank and the $1,250 or $1,300 or whatever we can rent it out for. Well, with the subject to transaction, we're trying to get control over this piece of real estate, and there's a very creative way to do that. And once we control it, we can then rent it out or rent to own it and try and create the spread. Okay, and there's multiple ways to get paid in a subject to deal. All right, and so the definition is controlling another person's piece of real estate, okay? Another person's piece of real estate by having them deed over the property to you, but leaving their financing in place. Okay, and we're going to talk about what that looks like here in a second. Owner financing is where the seller acts like the bank. Okay, so instead of going to a bank and getting a conventional loan, we're just going to the seller and saying, listen, I really didn't want to pay $150,000, but I would be willing to entertain it if you'd be willing to entertain carrying back the paper. Okay? So let's dive into subject 2. You know what I'm going to do? Because this is pretty far down. I'm going to do subject 2 over here for a minute, okay? So imagine this. Imagine we have a house, okay? With any piece of real estate, typically there are 2 things going on with it. All right, there are typically 2 things going on to it. One, I'm doing a really bad job. This looks like a horrible drawing. Let's try again. Okay, this is called a mortgage / trust deed. I was going to try and draw like a balled up piece of paper with like twine around it, and then that just totally imploded because it looked like a phallic symbol, and I deleted that. We went with the standard piece of open paper. Much better. Smart. It's a good move, Cody. Good move. Okay, so most pieces of real estate have a mortgage or a trust deed, okay? And that basically shows you who technically owns the house, all right? The other part over here is, I'm going to do a really bad, see if I can pull it off. Does that kind of look like a bank, like some bank in ancient Greece, maybe? I don't know. And over here we have our note. Okay? We have our note. I'm going to stick with real estate investing. Okay? So if you think about a house and you have these 2 things, right? You have the note, which tells who owes money on this house. Okay? This is basically tied to the loan that you took out. And then you have the mortgage or the trust deed, depending on what state you're in. Could we, in theory, separate the 2? So right now, the seller's name is on the mortgage, the seller's name is on the note. Could we have them deed the mortgage or the trust deed over to the investor, but leave this in the seller's name? That's essentially what we're doing when we're talking about doing a subject to. Okay? We're separating the note and the deed of trust. And when we do that, all we do is have them deed over the property to us. But we leave this in place. But now we got to pay that, right? We're not assuming it, because we're going to leave it in the seller's name. We're not assuming it as an investor. okay? But we're going to make payments on it, okay? And once we get control over it, now it's our time to clean it up real fast and go and create the spread, right? And there's reasons we would do this, okay? One, the seller is letting you pay their existing mortgage payments, which are down here, and we're assuming that the only reason we're doing this is because we're assuming that we can rent it out up here and create a spread, all right? We're not asking permission from the bank. There's no permission being sought, okay? And like I said, we're not assuming the loan. We would only do this type of transaction if two things happen. One, if we're stepping into good loan terms, okay? This note has to be good loan terms. You guys know what good loan terms are? Does that mean they're sexy? Does that mean they're smart? What's a good loan term? What if a good loan term was something like amortizing? Low interest rate. Ooh, I got one. Pick me. What if the loan, it was a 30-year loan, okay? And it was on year 15 of the 30-year loan. Would that be good? It's already like halfway done with the loan. Does that mean if it's an amortizing loan and it's a 30-year loan, like we're almost in the part where like when you make a payment, it actually goes to principal? Right? So when I talk about good loan terms, I'm saying you want to look at the seller's existing mortgage structure to make sure this isn't going to balloon to some, crazy interest rate at some point, or, maybe it doesn't have to be year 15, but, that would make it kind of sexier, right? So you just want to look. You want low interest rates, that kind of thing. All right? So what's great about a subject to is there are no loan fees. You're not getting a loan, all right? You're going to take over attractive financing like we just said. You can close it quickly because you're not applying for a new loan and going through that painful process. Most investors don't understand it, so you're going to be able to step in and create a creative deal where the other investors might show up and say, well, I only want to pay you $100,000 cash. And the seller says, I ain't giving it away for that low. I can't. Maybe I owe too much, or I'm just not willing to do it. And they walk away, but you get in and you kind of slide in and you say, oh, by the way, I'll pay you $100,000 cash, but if that doesn't work for you, would you entertain maybe something creative where I could take this burden off your chest, okay, take this burden off your chest, and I'm going to be able to help a seller in need by doing it this creative way that they didn't even know existed. And you can create, okay, if I sub to down here, but I rent to own on the back end up here, and I create the spread, I can get good ROI on my money, because if I structure a sub 2 right, maybe I don't have to put a lot of money down or any money down. So I'm going to get a good return on my investment, maybe like $400, $500, $700, $1,000 a month in cash flow. Plus, I'm going to structure it in a way that I'm going to, over the years, as I hold this piece of real estate in my portfolio, I'm going to be paying down the mortgage, which is giving me, okay, it's allowing me to gain equity. I'm riding the market up, so if it appreciates by 3 to 7% per year, I'm getting appreciation, I'm getting amortization. My ROI is really strong with something like this, right? Absolutely. So, you might be thinking, Cody, I love this concept, super cool, super creative. Is this legal? Because I was skeptical when I first heard this. I was like, first off, who the heck is going to deed you over their house but leave the financing in place? And 2, is this even legal? I don't even understand this. This is like crazy stuff to me. How does this work? Okay? So I did some research, and I put my attorneys on it, and I tried to figure out what the heck is going on here. Why are investors able to do this? And after ripping apart our legal code here in the United States, it's absolutely legal. It's perfectly legal. The only gray area is the seller, okay, the person who originally owned the house, violating the due on sale clause in their mortgage agreement, their note. So, if it's the seller that might have a small gray area that if they violate the due on sale clause, what's the worst that can happen? The lender calls the loan, right? So what's a due on sale clause? The due on sale clause is a little snippet of legal mumbo jumbo that's in their note that basically says if any part or piece or the whole piece of property transfers in any way, shape, or form without the lender's approval, that they have the right to call the note due. So, think that through. Why would a lender call the note due? Why would the lender call a note due? Well, they might call the note due if interest, they did the original loan down here, say at 4%, and then all of a sudden interest rates jumped to 7, 8, 10% because inflation or interest rates rise or whatever over the years, and they lended this out 15 years ago, and now 15 years have gone by and interest rates went from 4% to 8% or whatever, and the bank is saying to themselves, let's go and audit our books to see what loans we can call due because we really want to lend money out at this higher interest rate. It's better for us. So let's go and audit, right? That's one scenario. Does that make sense? The other scenario is what if the payments aren't made on this loan? Payment made, not made, right? Are they going to go and audit that loan to figure out what's going on? Oh yeah. They're going to audit the loan. So, as long as the interest rates don't jump crazy amounts, the bank's probably not going to go and audit it. As long as you're paying the underlying mortgage payments, okay, the bank's probably not going to audit it. Does this make sense? So, let me ask you this. What happens if they call the note due? So you show up at the homeowner's house, you structure the deal, okay? And I do this all the time with military families, and a lot of times, and this is a great strategy near military bases, I'll show up and I'll say, listen, you moved into town, you got shipped over to, say, Colorado near the military base, and so now you're here, you were living in barracks, your buddy shows up and says, hey, I just got a loan from this developer that's building this house development down the road, and it's less than what it's costing me to live in these barracks. I mean, they're like basically giving these houses away to military people. So these enlisted men and women run over and buy a brand new build, getting all this special financing, VA loans, all this good stuff, and now they're in the house, and they're in there for 2 years, and then all of a sudden they get deployed somewhere. And they get shipped out. And they ain't coming back to Colorado for years and years and years. So all of a sudden, they're looking at it going, great, now I got this property. I paid full market value for it. I've only owned it for 2 years. And I'm being shipped overseas for the next 5 years. I'm a lifer. I'm probably not coming back or whatever. I don't want a rental property. So you show up and you're like, hey, listen, I can pay you exactly what you're into the deal for. Just let me step into your shoes. You step out. I'll start making the payments. We're good to go. Right? Okay? Start making the payments, and now we're good to go. So, they step out, we start making the payments, okay? And we then put a tenant in there as fast as humanly possible that is going to pay a lot more. So now we're making a spread, okay? And we're going along. And one day we decide, or all of a sudden, out of nowhere, the lender calls and says, hey, we're accelerating the loan. Okay? So now you're like, oh man, what am I going to do? All right? So you have options. You have options. One, you can call their bluff or fight back. Probably not going to get too far. Two, you can immediately go out and borrow money from a private lender because you already have a history in this property. It's already cash flowing. And a lot of times on the back end, I don't do just a normal rental. I do a rent to own, where they're doing that's called a lease option. And what's happening is you subject to on the front end, you lease option on the back end, and I'll get like $5,000 down from the tenant buyer. So not only am I getting a big spread in what I'm paying in the monthly payment to what I'm collecting, but I'm also getting a tenant buyer instead of a normal tenant. They put $5,000 down or $2,500 down or whatever their option deposit is, and I'm renting it out at a premium, creating even more return on my investment. But I can show that I already have this deal structured, and I can go to a private lender and say, listen, I need you to come out and work with me on this deal. It's already all locked in. This guy's going to buy it. Maybe I told the original seller that, and they owe $150,000. I told my tenant buyer they could buy it for $200,000. So I already have this whole deal arranged. All right. I could potentially even just go down to a bank, get a conventional financing deal, because I already have control over the property. I already have rental history for a couple years or whatever. I already have the buyers and everything lined up. I'm showing this long history. It's going to be easier to do a refinance. Property's already in my name. I just need to refinance out that loan and get it out. All right. Or worst case scenario, I can call back up the seller, the military guy, and say, listen, man, the lender called your note due. I can't refinance, or for whatever reason on their son, or I'm having a hard time. I'm going to deed the property back to you. Okay? It's already got a tenant built in there. The lender's just throwing a hissy fit because they noticed that the property was transferred. I'm just going to deed it back to you. Oh, what if they never were even able to see that the property transferred because we used a trust? Would that be creative? What if instead of just deeding the property over, we deeded the property into a land trust? Ah, that's creative. Into a land trust, and now it's kind of hidden behind the trust. That's smart. You know what? Let's do all our subject to transactions like that from here on out. We deed the property into a land trust, and we call the land trust the 123 Main Street Trust, or even the original seller's name. Johnny Seller Trust. Creative stuff right there. You have options. You always have options. So if we know it's perfectly legal, the next question is it ethical? Okay? Is it ethical? Because if it's legal and it's ethical, we're going to do it. If it's legal and it's not ethical, we're going to have a challenge wanting to do it, right? So let's think about the ethics behind this. So what if, are we a party to the transaction between the lender and the original borrower, aka the seller? Are we even a party to that transaction? Do we sign any paperwork? We don't have anything to do with that relationship, right? The seller and the bank have a relationship. They signed an agreement that said, and there's that little due on sale clause in there that says if you transfer the property and we catch you transferring the property, we have the right to call the note due. Now, is the buyer, me, the investor, required ethically or legally to notify the bank that that seller has transferred the property into a land trust and or directly over to me? I'm not a part of that transaction. I have no fiduciary responsibilities whatsoever. My whole thing is I'm showing up and I got a serviceman or woman that is being shipped overseas and I'm trying to help them out. I feel like it's my ethical responsibility to help this person unwind or figure out a solution to their housing problem. That's where I'm coming from. Now, should I ever make any recommendations to that original seller to lie to their lender? Never. Never. I'm never going to tell that seller to lie to their lender. In fact, I'm going to tell them, do not ever lie to your lender. Whatever you do, don't do it. Okay? Do not make false statements in any way, shape, or form. If they call you, okay, and they ask you questions, you either say nothing at all, do not make any statements, just say, I will call you back. Okay? Hey, now's not a good time, totally understand. Maybe what you're seeing is not accurate. I'll call you back. Let me find out. Okay? And that's it. No false statements. Don't say yes, don't say no, don't make an email, a commitment, nothing. You just don't say anything. All right? And to be honest, what are the seller's other choices? They're going to rent out the property, become a property manager, go upside down in that property potentially, have a management nightmare. They're overseas fighting for our country or whatever they're doing. They don't have a lot of choices. We are their solution. You guys feeling what I'm talking about right now? So you're making your own judgment right now whether or not a subject to is ethical or legal or whatever. I'm just leading you to the information. I love subject to, if it's done the right way. And the key is all in the paperwork. The key is understanding how to fill out the paperwork so everybody is on the up and up. Everything's disclosed. The trust is set up. All the disclosures are signed by the original seller. We make sure the original seller sends in notification to the lender to send their mail to a different P.O. box. We have insurance on the property. Everything's on the up. We use a servicing agent if we need to. There's a whole right way to structure these type of deals. You guys like subject to? Is that something that you could see, hey man, if I understood that paperwork and I knew a little bit more about subject to, I think I could do one of those deals. Put in a property right into my portfolio, create a spread, get good ROI, help out a homeowner. Sounds pretty good to me. All right, let's keep it going. So what if you show up and there's no loan on the property? Okay, no loan on the property. So the seller wants, you offer $100,000, but the seller wants $150,000, and they're not selling for a penny less than $150,000. They own that property free and clear. There's no financial pain. They're saying, no way, buddy, I'm not selling for anything less than $150,000. I inherited this property from my mama. I'm not selling for 1 penny less than what I want. Whatever their situation is, if they do not have a loan on the property, because if they have a loan, you're going to look subject to. But if they don't have a loan, we're going to immediately transition from subject to seller financing. Right? So, do you have a loan on your property? No, I don't. Okay, seller financing. Boom. Going over to that bag of tricks. All right? Also known as seller carryback, also known as owner financing, and it's basically the seller plays the bank, and they place a lien against the property at close of escrow, and whatever terms you negotiate with that seller, that's what the terms of your note are. That's your deal. So common terms include between 5 to 15 years, okay, in duration. Every time, and once in a while, I'll do a 30-year note, but it balloons earlier, and I'm going to show you what I mean by that. Can I erase this stuff, guys? I'm gonna erase the subject to stuff. All right, I'm going in. Okay. Seller financing. So, seller wants $150,000. I show up and say, listen, what do you think this property will rent for? And they say, it'll probably rent for $1,500. Okay, rent. Okay, rent, let's just say, is $1,500. If we did rent to own, we could probably get between $2,500 to $7,500 down, maybe more, plus the rents, okay, as an option deposit. So these are our initial assumptions going in. The seller wants $150,000. What if we showed up and said, hey, listen, I'll pay you $100,000 cash, or, and I got to talk to my business partner about this, what if I was willing to get creative with you and work something out where we did a short-term loan where you carried back the paper? Would that be something you'd be interested in? And they go, well, what do you mean? And I say, well, listen, I got to structure some stuff and work it out with my partner, but if that's something you're interested in, I'm willing to put in the time and energy to try to figure out what's the best creative solution for us, so that way you can sell for $150,000. Maybe it's only worth 140. They want 150, whatever. Maybe there's three other, you're in a competitive market and there's three other offers that just came in. And the guy's trying to sell the house for 130, and then all of a sudden three 130 offers show up, and you come right behind it and say, look, what if I could pay you 150? Would that work? And he's like, wait, what do you mean 150? That's $20,000 more than ask. Well, yeah, what if I got creative? You don't have a loan on the property. What if you carried the paper for a little bit of time? And I was able to give you a huge return, extra 20 grand in your pocket. But you just have to wait a little bit for it. Would that be something you'd be interested in? Well, yeah, I'm in no hurry. Let's do that deal. There's a lot of ways you can use this to outmaneuver your competition. But so you show up and you say, okay, here's what I would do. Let's do a deal where it's a 30-year note, balloons in 5. So it amortizes over 30 years, it balloons in 5, and I'll pay you until paid. Guys hear what I just said? It's a 30-year note, balloons in 5, and I'll pay you until paid. You guys know what the words until paid means? This is a secret phrase. This is Cody's secret phrase. Write it down right now. Write it down. I will pay you until paid. What that is saying is 0 interest. Without saying, I'm going to give you 0 interest. I'm going to pay you until paid. Okay? 0 interest. So if you went to Google and you went to a mortgage calculator right now and you put in a $150,000 loan over 30 years at 0% interest, it's going to spit out some number. I don't know what that number is. I'm making up numbers right here. But let's say that number is $980 a month. Okay? A 30-year note. So every month you'd owe $980. And I'm totally, one of you guys do it. Go to a mortgage calculator right now. Tell me, put in $150,000, date starting today, go out 30 years, okay, and 0% interest. Tell me what that monthly payment is. It's not going to be that much. Okay, so somebody asked about a down payment. You get to make the rules. This is what's great about seller financing. You make the rules. You want to put a down payment down? Let's do, I'll step right in. Let's say I'll pay you 5 grand down. What do you have? Whatever you have at your disposal. 0 down, 2,500 down, $1,000 down, 5 grand down, 10 grand down. Whatever it's going to take for you to get the deal. Somebody's putting $417 a month. I mean, geez, I was way off. So you guys understand this, right? Have you heard this PITI? PITI stands for principal, interest, taxes, and insurance. So let's say the principal is $417, and then now we got to add interest, add taxes, add insurance. So let's say by the time we're done, we're at $900 a month or $800 a month or whatever it is. Okay? Because you always want to clear out all your expenses, right? So maybe I put 0 down. I just say, look, I'm going to step in. I'm going to pay you until paid. But what the benefit you get is in 5 years, this thing's going to balloon. And whatever principal balance is owed at that time, I have to either refinance or pay you in cash and clear you out. So what's great about this, by amortizing it over 30 years but ballooning it in 5, I've lowered my monthly payments to create the spread between this and this piece and this PITI that I'm paying. Is this making sense, guys? We're starting to get into this a little bit more complicated deal structuring. I'm building upon everything that we've been talking about in these series. Now we're starting to get into the more complicated stuff. But if you start to understand, wow, whatever I come up with and the seller agrees to, I could do this type of deal. I could say no money down, and maybe they come back and they say, what does until paid mean, Cody? Well, that means I just make you principal payments until the thing's paid off, and every time I make a payment, it goes towards the principal, and we pay it down. And they come back and they say, I'm not doing that for 0%. What are you, nuts? And I said, well, what would you like? Would 2% work for you? No, I don't want 2%, I want 8%. Hey, Now we're getting into conventional financing, worse than conventional. We're getting into soft money territory. Why don't we work something out where I do, and I got to talk to my partner. I don't even know if they're going to approve this, but what if I did 4%? Would 4% work? I mean, it's going to be challenging for me to get them to accept that in this scenario, but I mean, we are paying you 20 grand over ask. Would 4% work for you? You get where I'm going with this? This is nothing more than a negotiation. Work out your terms, but you know that you only have a few terms to negotiate. There's not many. Down payment, length of loan, interest rate. Okay? There's not many things to negotiate. So you start at the best and then you work backwards. Transactional engineering. All right, I'm gonna erase this stuff, okay? How you guys feeling so far? You guys digging this? I wanna make sure because I can stop at any time, but if you guys want me to keep going, I'll dive into the next thing. All right, I'm getting into the good stuff. Who else is here? Somebody said Grant's in the house. What's up, Grant? If you're here, baby, take a seat. Get out your pen. I'm going in on this one. All right, so now let's talk about, so we talked about the different funding strategies. Now we just went into cash versus terms. We went through subject to and seller financing. Do you guys know what a wraparound mortgage is? These were big in the 80s, and not a lot of times do we do, got my pen out, thanks. Grant, you're the legend, man. So jump in anytime, add your 2 cents. But wraparound mortgages were really big in the 80s. And what I've done in the past, if I sometimes go and I see that the seller has a mortgage on their property, and I start thinking subject to, but I'm worried about the due on sale clause, a lot of times what I'll do is I'll shift from a subject to, because subject to has a lot of moving pieces, over to a wraparound mortgage. And a wraparound mortgage typically occurs when they owe, like the last one I just did, the seller owed $90,000. But they wanted me to, and they owed $90,000 to Chase. But they wanted to sell to me at $150. And I agreed to pay $150. Okay? This is a long-term rental that I was going to put in my portfolio. But all I wanted to do is step in and start making the Chase payments, which are, they only owed 90, and they were at year like number 20 out of 30 of their loan. So I showed up and said, listen, here's what I'll do. Let's get creative. You want to carry back this difference between the 90 and the 150. I'll allow you to do that, but this second half needs to just sit there until my deal balloons in 5 years. So I'm going to put the deal here. I'm going to put your giant equity piece, this carryback, on top, and I will wrap the two pieces together. So we have this underlying lien that I don't want to get called. I have my seller carryback here. I'm not going to make any payments on this carryback. You're just going to get a big balloon payment in 5 years. This piece, I'm basically going to step in and start paying those payments. I'm not assuming the loan. I don't want anything to transfer, but I'm going to make the payments that are owed to Chase. Okay, you guys see what I did? And I wrapped the whole entire thing. And now, instead of deeding the property over to me, they did a contract for deed over to me. So now I have the rights to the property, meaning I have tax benefits, I have control over that piece of real estate. It's transferred out of the old seller's name, but it's not going to notify the bank because it doesn't actually complete the transaction until the last payment has been made in the wrap. All right? Super complicated. Your closing agent is going to help you structure that entire deal. All you need to do is show up and say, hey, they want to do a carryback, but I'm not going to make any payments on this carryback. I'm only going to pay the bottom part. Is there a way I can wrap this mortgage? Can you help me with that? How do I fill out the paperwork? I didn't know anything about wraps when I first started. Somebody else helped me with the whole entire thing. But that's a wrap. Would you guys say that wholesaling is a financing term? Because we're going through all these creative ways to do a deal. Is wholesaling a creative way to pay for a deal? Wholesaling is a financing strategy, believe it or not. It's a financing strategy. So, wholesaling works when they accept your all-cash offer. Terms works when they either have a mortgage or don't have a mortgage, and they're not going to accept your all-cash offer. They're not motivated enough to sell. All right? Wholesaling is an all-cash offer strategy, a financing strategy, where the end buyer funds the transaction. Okay? The end buyer funds your transaction. And wholesaling is really simple. It's normally the gateway to getting into becoming a real estate investor. And the simplest way to explain it is you are a middleman or a middlewoman. And all you're doing, so you have a house here in the middle. Here's you. Here's, I don't know why I just drew a wiener on this guy. I wish I wouldn't have done that. Moving on. Here's your cash buyer. We'll call him Mr. Big. We're rolling with it. This is live, ladies and gentlemen. This is live. All right, Mr. Big over here wants to buy real estate deals, but Mr. Big doesn't have enough time to be Mr. Big. All right, so he's going to come to you, the wholesaler. Wholesaler. God, I cannot spell. I'm under pressure right now. I almost just spelled wholesaler. Wholesaler. Okay? And he's going to say, what inventory do you got? And you're going to say, well, I just got this house under contract. Okay? And I just put it under contract. And this is under contract at a really big discount from retail, and it's not on the MLS, or you can't get it anywhere else. I have complete control over the property. And he's going to say, look, I'll buy that contract off of you. That's it. That's wholesaling. You're going to say, yeah, I'll sell you my rights into this contract. I haven't closed on the house yet. All I did was put this house, I found the house, I negotiated with the seller, I put it under contract. But Mr. Big, if you want to step into my shoes, go ahead. And I'll go ahead and sell you the rights to my contract. I'll either do one of two things. I'll assign it to you, or I'll double close it over to you. All right? That's wholesaling. I have books written on this, courses written on this. I'm not going to go into this too hardcore, but it really is a financing strategy because it's Mr. Big's money that you're using. That you're either going to sign the contract onto them and make 10 grand or 5 grand or whatever, or you're going to use their money in an A to B, B to C type transaction, aka called a double close. All right? I don't want to spend too much time with wholesaling. Video number 1 in this entire series breaks this whole entire process down. All right? What I want to focus on is raising private capital. And this is how we're going to finish the video. All right? We're going to finish the training right now by talking about raising private money. Will he know how much you made? If you assign it, yes. If you double close it, no. How do I find Mr. Big? That's a great question. You could find them, I find them by going to local RIA meetings. I find them by going down to the trustee sale and hanging out and talking to people that are down at the foreclosure auctions. I find them through other wholesalers. I backwards engineer. Like, let's say I identify the biggest wholesaler in my market. Okay, let's just say you were backwards engineering my buyers. You go to the tax records and you look up, you find out the name of my LLC that I do all my real estate wholesale deals in, and you go to the tax records and you look up that LLC and you see all the transactions, okay, where I buy and sell, buy and sell, buy and sell. Well, you're going to see who I sell to, right? It's not that difficult to backwards engineer and steal somebody else's cash buyers. Look them up. Find out my LLC that I sell houses in, backwards engineer it, and you'll end up being able to find out my cash buyers. Look up their LLC, look up, Google them, do whatever you got to do, send them a letter. Hey, look, I also have access to off-market deals. Nobody else has these great deals. I'm a master marketer. When you're a wholesaler, you're a master marketer. That's what your job is. You're hustling out there, house hustling, trying to find deals, and you're just matchmaking, right? You're in the middle, matchmaking. What about this? I'm going to talk about this for private capital because this is a great strategy to raise private money, but call the local Lamborghini dealership. You know, since I'm a new Lamborghini owner, I called the Lamborghini dealership. I said, hey, do you guys have like Lamborghini meetups? I want to get involved and race around town with other Lamborghini owners. And they go, yeah, every first Saturday of every single month, all the owners of cool cars get together and have coffee and cars. There you go, cars and coffee. And I'm sitting there thinking to myself, that's brilliant. Why would I not be down there with everybody who's got big money to raise private capital from or to find cash buyers? They all got exotic cars, all $500,000 cars and whatnot. So go down there. They're there. They're out there. You just have to get creative and figure out where to find them. Talk cars, talk golf, talk sports, talk anything. Build that relationship and you're off to the races. All right, we're going to wind this video down. So let's talk about private capital. All right, so wholesaling is a financing strategy. These are all financing strategies. The last one on here is private money. What I love about private money is it's the best form of financing under the sun because it's whatever, it's kind of like a seller financing deal. Whatever deal you structure, you get. So the better you are at negotiating, the better you are at building a relationship, the better your private money deal terms are going to be. All right? So private money is basically trying to find money from anybody that you can talk to that has what we call lazy money laying around. Okay, have you ever heard that phrase, lazy money? Your grandma might have some lazy money, right? The guy who does your dry cleaning might have some lazy money. Your accountant might have some lazy money. Your parents might have some lazy money. Your best friend's parents might have some lazy money. This is mattress money. This is money that's not earning them returns. The stock market is brutal right now. Cash is king, right? They're hoarding their money. Well, they're always out looking for places to put their money. All right? These people are what we call your financial friends. Okay? And you want just a couple really good financial friends. It's going to be a game changer for you. What I love about private money is it's lower interest rates, it's flexible terms, it's whatever we negotiate. There's a million different ways you can structure these private money deals. You could do it as a straight loan, you could do it as a partnership deal. It's by far the best type of money out there. Somebody just says, are you a millionaire? No, Mob, I am not a millionaire. I'm a multimillionaire, but thank you for asking. So, stocks versus private capital. Let's think this through. Stock market, unsecured, volatile. Returns are unknown. It's not physical. You can't actually go and touch the asset. It's not tangible. 401ks can become 201ks. There's fees. There's broker fees. It's unknown, right? Unless you're Warren Buffett, you're winging it. And you got to do all the work. You're self-managing a lot of times. Private mortgage loans, totally different. Amazing opportunity, okay? It's secured by a note or deed of trust or a mortgage. There's collateral. It's physical. It's a tangible asset. They can go check it out. The collateral is actually insured. If the thing burns down, they're going to get a check. You're a professional. You know what you're doing. They're not having to do all the work. You're doing all the work. Sounds like a pretty dang good deal to me, right? Why would I want to do stock market? I'd rather do private capital. Sounds like a pretty big opportunity for your financial friends. So where do we find private money? Friends and family, real estate attorney referrals, maybe go down to the IRA custodian and ask them if they have lunch and learns and go and hang out with people that have a bunch of money in their IRAs. Professionals that are busy, attorneys, accountants, small business owners, your grandma, like I said, doctors, go down to the hospital. I raise a lot of money from hospitals. You get in with the physicians and the surgeons and the anesthesiologists. I mean, they got crazy money that they want to put in play, right? They're always trying to parlay their capital. So there's two different types of private money out there. There's equity versus debt, okay? Equity versus debt. All right, equity versus debt. So equity lending is where the private lender is like a partner in the deal. All right, they're going to partner up with the deal. They're going to get a portion of the ownership. Maybe it's a 70-30 split, 60-40, 50-50, whatever. And they're going to get paid from the deal proceeds. All right? The challenge with that is you have a partner. You're sharing the risk. That's the good part. The downsides are there's less profit for you. And you have a partner. And typically people with money believe that their money is so much more valuable than your hard work. So if you want to remain in control over your deals, probably not a good idea to get them involved on a equity play. All right. On the flip side of that is the debt side, and that's where private lenders are a true lender, and they're basically making a loan with whatever flexible terms you guys negotiate. The loan's secured, like I said, with the note or deed or trust. They're paid a specific rate of return over a specific period of time, and there's more profit for you, more control for you, and at the end of the day, you are taking on a little bit more risk, but it's probably going to be worth it if you structure the right deal on the right piece of real estate. All right? The only warning I want to give you when raising private capital is the SEC, the Securities and Exchange Commission, they monitor and enforce the guidelines of this thing called the general solicitation rule. And you just have to be careful how you generally solicit to raise your money. So I don't recommend just going on Facebook or just shouting out to the middle of, the street, loan me money, I'll give you guaranteed returns or anything like that. I would say flip it, and instead of going out and saying I'm looking to borrow money, because the word borrow immediately creates a connotation or a physical feeling in somebody's head, right? They're immediately going to go, I don't want to loan you money, right? The wall's going to go up. The objections will come up. I never say, hey, I want to borrow money. I come from an educational angle always, and I'm always saying, listen, there are secrets to earning higher returns that are backed by real estate that are much better than investing in the stock market. If you want to hear about these opportunities, let me know. There are secrets to earning higher returns that are backed by real estate, much safer than the stock market. If you want to hear about these opportunities, let me know. Well, what do you mean? Well, I'm an expert at what I do. I go out and find real estate, and these deals are amazing deals. Sometimes I rehab them, sometimes I rent them, sometimes I wholesale them, but I'm always looking for capital partners. I can't do every deal in-house, so I like to bring on strategic partnerships. I don't bring on a lot of them. In fact, I'm going to make sure that this is a really good fit before we move forward, but every single deal is the best. I will never put anything in front of you that's not the absolute best deal that I have access to, and I'll tell you why it's the best deal, and we'll be able to move very, very quickly on it and make a bunch of money together. Do you want to learn more? Because I'd love to take you out for coffee. All right? We're giving them an opportunity. Now, typically what I do is I set an appointment to have some coffee with them, and then I sit down and I actually have my iPad out and I flip through a presentation. Right? I'm not winging it. I actually know what I want to do, and I flip through a presentation and I say, hey, listen, I got this excellent opportunity for the right person. Let me explain how the whole thing works. And I have a strategy, and I flip through it. I go through my PowerPoint, and by the time we're done out the other side, I've answered 90% of their questions. I've shown them a couple example deals. I explained who I am, why I'm an expert. And then I look at them right in the eye and I say, listen, I don't have anything for you right now. But I just have one question. I just want to know, if a smoking hot deal shows up and we're going to make great money on it and it's a winner, are you in a place where you're prepared to be able to pull the trigger on this very, very quickly? Because I'm looking for strategic partners that can quickly put the capital in place so I can move quickly. Because the reason I get such smoking hot deals is because I pay cash and I move fast. And these sellers, they're motivated to get their cash. So can I call you, show you the deal, and within a few minutes get an answer, yes or no? And I'm totally fine if you pass, but if you give me a yes, I need to know that you're committed. Simple, right? They're going to love you for it. So stop hiding. Go tell everybody that you know. Have the strategy and go tell everybody that you know what it is that you do. And start raising some private capital. The best way to do it is put a single lender into a single property. Okay? avoid doing multiple lenders on one property when you're first starting out. Don't do that. Single lender, single property. Typically, there are no upfront fees, 6 to 14% interest, 6-month to 5-year terms. You negotiate. Interest can be paid monthly or at the end of the term. Obviously, it's better for you if you pay it at the end of the term. So, you get to negotiate however you want. There's no cost to the private money lender for this. All fees and expenses are going to be on your end. They're going to have a note and deed of trust. They're going to have insurance. Your closing agent is going to help you put all the paperwork together. My closing agent can create the note and deed of trust and the promissory note, the deed of trust, and any other paperwork that we need. I'll get lender's insurance on it if I have to. Through my title company, they're secured. Remember, the biggest takeaway from this conversation about private money is you're presenting an opportunity. You're not asking to borrow money. And there's a lot of places you can raise private capital. You just haven't tried yet. And when I raised $2 million, I didn't even know that I was going to raise $2 million. I was buying properties down at the foreclosure auction. I hired a guy named Brian to drive properties for me. Brian was like 6'6", 220 pounds, carried a ginormous Magnum 45 or whatever it was, gun on his hip. He was like this typical big guy that would go and drive properties for me, take pictures, do property analyses. And I was back behind my computer talking to my bidders and bidding and buying properties. So he was out driving and I was negotiating and running the bids. Well, after about 2 months of him working for me, and I'm paying him like 13 bucks an hour or whatever it was, I finally looked at him. I'm like, Brian, you have a family. Like, how is it even possible that you are surviving right now? Does your wife work? And he's like, no. I was like, do you love what you do that much? And he's like, oh, I love it, man. I'm so jacked up. I think it's the absolute greatest gig in the world. Thank you so much for giving me this opportunity. And I'm thinking to myself, you're like 48 years old. Like, what opportunity? Like, you make 13 bucks an hour. I get it. It's a cool job. You wear your gun. You look the part. You act the part. What gives? He goes, oh, I'm kind of like what do you call like a trust fund baby? I got some money coming in from my dad. Instantly, I was like, tell me more. Tell me a little bit more about that. That sounds interesting. So he starts spilling his beans about how his dad was this huge bigwig in Wall Street on the 1980s, and he structured all these major mergers and acquisitions, and he made hundreds of millions of dollars, and he lived somewhere in Florida part-time and in France part-time. And I said, hey, I don't know if this is something you'd be willing to do, but would you be willing to call your dad and let me talk to him for a few minutes? And he said, oh yeah, I've been telling him everything about what you got going on. So I said, well, let's get him on the phone. Dad gets on the phone. I said, hey, Brian was just telling me everything about you, and I would love to have a conversation about how we could potentially make some money together. I got some really great opportunities. And he cut me off. He said, Cody, I'm going to France, not tomorrow, but the next day. And this was like 3 o'clock in the afternoon. And I said, oh, how long are you gone for? And he goes, I'm gone for like 6 months. If you want to talk, you better talk fast, because I won't have time to do anything. Once I go there, I check out. I said, okay, I'll see you here in a few hours. Now I'm in Arizona. He's in Florida. Hung up the phone, bought a plane ticket, went straight, got on a plane, flew to Florida. I didn't even go home. Showed up, private money presentation, flipped through the thing, got Brian's dad to love me, walked out of there a day later with a $2 million line of credit. That's it. That's how fast that happened. Okay? Came back, turned the auction business on to hyperdrive, started working with his attorney. I bought every house under the sun. So a lot of times when you're like, how did you get to 1,500 plus deals? Well, it's because I made a decision to get on a plane and go raise a bunch of money. And I lit it on fire after that. And when you have access to, but I had some experience, I had a strategy, I had a game plan, I had a presentation, I knew what I was asking him for, I structured the deal the way I wanted to structure the deal, I got the line of credit, I knew what to do with the money once I had it. Right? And there were still a lot of other little nuances, but at the end of the day, you work through those in real time. You don't stress about those at the beginning of the deal. All right? So, recap. Wholesaling, your end buyer funds. Fix and flip, you can use other people's money. Okay? You can use conventional, but probably not the best idea. You really want to use hard money or soft money. Buy and hold, you can get the seller to participate, do a creative real estate deal. You can use conventional financing. You can roll your wholesale profits into your buy and hold dollars. You can REOs and short sales. You can do transactional funding, cash, hard money. And if you want to build and develop, do private money. Private money also does your fix and flips, but private, conventional, soft, whatever. So, I mean, you got tools now, right? You got lots of tools for financing, and we talked a lot about structuring deals in a lot of different creative ways. We've now been here for at least, I don't know how long, 2 hours, hour 40 minutes, something like that. And you guys have hung in there like champions. But all the knowledge in the world, all the information isn't going to get you to where you want to go unless you take massive, fast, immediate action on it. So if there was any takeaway, it would be to learn this stuff through deal making. You hear it, you digest it, and then just get your butt out there and start working it. And screw up, have fun, celebrate, push yourself harder than you've ever pushed yourself, play like a champion, think like a champion, surround yourself with great people, and there's nothing that can stop you. I shared some of my goals in another video. I want to make it on the cover of Fortune magazine. I want to buy La Cala Island someday from the guy who owns Red Bull. You know, I'm gunning for really big dreams, and I hope you are too. I hope to see you on La Cala Island one day as one of my guests. But as somebody who can be there and mentor you through the process, you need good people in your corner to pull you there and get you there. And I want you guys to know that I'm there for you every step of the way, whatever it takes. That's my mentality. All right, that's it. That's all I got. And if you're watching this as a replay on YouTube, I just want to say thank you for hanging in there as well. And to all my Periscope subscribers, you guys are the absolute best. Best family in the world. Team Clever Investor, best family, especially on Periscope when it comes to real estate investing. We own this. We are the game. All right. That's all I have right now. Appreciate you guys. Until next time, take care. Comb your hair. This is Cody Sperber, the Clever Investor, signing off.